obviously pre-COVID, because he's got a much better haircut then.
Yeah.
So a little bit on Nick. I've known Nick for more years than I care to remember, to be honest with you. I don't think either of us had grey hair when we first met. Let's put it that way. So it was that long. I was probably still single, actually. I'm now married, 4 kids and 7 grandchildren. So that's how long ago it was. So a little bit on Nick. Nick used to previously worked at Avco Trust back in the 1980s, and has since worked for a variety of mortgage loan providers. Joined Paragon in 2004 to enhance their second mortgage offering, and really has been instrumental in helping Paragon to become a leading player in the market today. Outside of work, Nick is a keen sportsman. He's retired from football and cricket, haven't we all? Nick can often be found crawling out of bushes at the weekend, and this is where I'd like to actually maybe, if I could do something where I could add some animation, I then have him retrieve yet another wayward golf ball, but only because what would he be doing crawling out of bushes at the weekend otherwise? So everybody, you should have received this, which is Paragon's criteria. There's 2 pages to this, which is just their basically terms with ERCs and terms about ERCs. So without further ado, I'm going to put Nick on. I'm going to go and have a good stiff drink, and here comes Nick's presentation. Nick, over to you.
Many thanks, Tony. Many thanks. Can you hear me okay?
Yeah, I can hear you fine.
Lovely. Morning, everyone. And isn't technology great? But hey ho, we're all learning, and these things happen, and I'm sure it'll all be fine, Tony. So a bit about me. Well, as Tony said, I've been around for quite a while, and in the last 16 years, I've been concentrating on the second mortgage side of things with Paragon. I will explain a bit about Paragon in a moment, how we're set up, etc. But the second mortgage side is probably one of the things that a lot of you haven't perhaps dealt with, and I just wanted to make you a little bit more confident, hopefully, on where a second charge would help, and some examples of second charges and where they come into their own. So without more ado, we'll go into the second slide. So who are Paragon, or who is Paragon? I take it a lot of you have dealt with us on the buy-to-let side, on the first mortgage side, which obviously is Paragon's main bread and butter. Been very, very successful in that. We're at the start of the buy-to-let boom, and have now progressed into a more kind of niche area, mainly on professional landlords who have got 10 or more properties, that kind of thing. So Paragon have done very well out of that, but they've also now moved into various other areas within finance. It includes asset finance, mortgages, motor finance, and savings. And back in the last recession, one of the best things we ever did out of the financial crisis was we became a bank, and thank goodness we did, because from you seeing what's happened, Tony talked about shortage of lenders and products, and a lot of that is obviously down to the fact that lenders aren't able to raise funds available to lend out again. And we now have a substantial savings arm, a lot of bonds, a lot of fixed term products where customers can borrow money through Paragon, and we use, if to all intents and purposes, use that money to lend out again through the mortgage and second charge arms. So it all seems to be going quite well, and we're so glad we did that, albeit it wasn't easy. I think there was about 1,000-page document had to go into the FCA. So that's us. More apparently, what do we actually do? What do I do? Well, I'm business development manager for the south of England, and we've got my equivalent in the north. We kind of say Birmingham is the dividing line. So I don't know where all you guys are, but hopefully I'd be the development manager for most of you. Dealt with Tony, as he said, for many years, and we see specialist financial services as a very important professional partner of ours, and they do a lot of the legwork for you. So their staff have been well versed and well trained in second charges, got a good idea of what lenders will and what lenders won't accept, and if you speak to them, they'll know exactly who a case will fit with. Paragon, to be honest with you, we've made a good business out of being very very keen on rate. So we offer the best rates in the market, but we want the best customers in effect. So we want people who are, to all intents and purposes, haven't really had a lot of problems in the past, are rate conscious, and will pay us back. And I don't think we'll ever waver from that. That's just our business model. Not saying that's right or wrong. Obviously, we could make more margin if we allowed for more adverse perhaps and raise the rate, but our business model has always worked for us, and we're keen to stick to that. So we've got very, very competitive rates, as you can see from the first bullet point on that slide. Very competitive rates. Second charge rates starting now at 3.37. Who'd have thought that? I think when I started, it was in the 15-16%, and people were very reluctant to even talk to their clients about second charges, because why would they? Very, very expensive. Now I think it's a very, very a viable alternative to a remortgage, and I'll come on to that further down the line. So we deal with employed and self-employed people, and the rates are the same. And I think Tony sent you all rate charts, and I'll come on to a slide with the rates on it further down the line. We've got variable and fixed rates available, interestingly, with ERCs and no ERCs, early redemption charges. So one of the things that stopped second charges expanding, I think, as they perhaps should have done a few years ago, was the early redemption charge situation. We get a lot of people who come to us because they've got very keen first mortgage rates. They might have a tracker rate or a very good fixed rate, and they've come to do some home improvements 2 years into a 5-year tracker or 5-year fixed, and they're thinking, well, I don't want to touch my first charge scenario because I've got ERCs with that, but I don't want to take something out where I have to pay ERCs if I settle it. So something like a 5-year fixed or a 3-year fixed rate on a second charge with no ERCs would fit in very nicely with their plans if they plan to then remortgage away the product when it comes to the end of its term. So that's we're getting a lot of those kind of customers. That fits in nicely with our business plan. AVM, automated valuation model facility, means full valuation fees can often be avoided. Valuation fees on second charges are lower than first charges generally, but we're now doing a lot of more AVMs than we ever have. We go up to 70% by AVM now, and I'll come on to the products in a minute. We used to go up to 80% on AVMs, and I'm sure we will again, but we've had to put some changes to the products in just while this pandemic that you might have heard about, by the way, something going on at the moment. Whilst this is happening, we've had to change things slightly, but only temporarily, hopefully. Another big one, which I tend to overlook because I'm just used to it now, is the no solicitors fees to pay, and things are a lot quicker because there are no solicitors involved on second charges. We as a lender do all the legal works. Okay, so an average, people ask me, how long does an average second charge take to complete? Well, at the moment, I'd say between 3 and 4 weeks, provided the customer gets everything back to us, wage slips, that kind of thing. So very, very quick now compared to a remortgage. So another good benefit there. On to the next slide. There's a few other things. Obviously, that first one, a quick payment of funds via TT, no problem. Overpayments can be made at any time. That's another thing people ask me. Obviously, with no ERC plans, they can repay at any time. But even if they have got ERCs and the early redemption charges would mean they get a slightly better rate, and I'll come on to that in a moment. But they only last on the variable rates for 2 years anyway. So, if they were taking a 15-year term, they would only actually have early redemption charges for the first 2 years of that on a variable rate anyway. Okay, but they can overpay. Currently, it's up to 10% of the loan amount in any 12-month period. I I've covered the thing about protecting an existing first mortgage rate and structure. I haven't done I've done the rate, not the structure. So there are a number of people that are still on interest only and don't want to change their first mortgage away from that. One way to avoid doing that, because generally when you remortgage these days, you have to go on to repayments, is to keep your existing structure on your first and take a second charge out. All our second charges are on a repayment. We don't have any interest only, but what I mean is they could keep their first charge on a interest only basis and take out a repayment second with us. Okay, and avoid first mortgage ERCs that may be incurred by remortgaging, as I said earlier. Okay, covered those points there. What I normally do on these things, I don't actually like just to read out the bullet points, and so that's fine. But then I find I've covered half of it when I come to actually look at the slide. Now, the term they take it out can extend past first mortgage term. I get asked that quite a lot. It doesn't have to tie in with the term of the first charge. All that would happen is that when the first charge is up, we would become first mortgagee. You see what I mean? Can be used to consolidate any amount of outstanding credit. So this is a big one with us. Probably, I don't know, 75%, maybe 80% of what we do is for consolidation of outstanding debts. So by putting them all into one pot, you can save a substantial amount on your monthly outgoings. You obviously have to be careful and give the right advice. You don't want people consolidating credit which is of a lower percentage rate than ours. But having said that, if we're at 3.37, there's not much credit other than your interest-free sofas and stuff that you shouldn't be consolidating, I suppose. We've got plans that are available up to 75%. Was 85. I'm sure the 85 will come back sometime in the future, but at the moment it's 75%. Are possible on terms extending past declared retirement age. So we now have plans, because you've probably seen it. Everyone seems to have been talking about this, that the demographic of borrowers at the moment is getting so much older. A lot of younger people are priced out in the market or just can't get the deposits. Now we're seeing a lot of late 40, early 50-year-olds wanting to take out second charges, which is difficult because sometimes you can't make it fit on affordability. So therefore, we have to extend the term. And what we say is, provided someone can prove that they're paying into a pension plan and are at least 10 years away from their declared retirement age, to give time for that pension plan to build up, we'll end up to age 80. Okay. We allow adverse credit on some plans. We're not an adverse lender. I think I made that plain initially, that we're looking for quality customers. But the odd blip here, there, and everywhere on credit cards, 1, 2 down, maybe a little bit of adverse on some 1 month they might forgot to reset the direct debit after a payment holiday, something like that. That to us is okay. We do credit score. It's built into the credit score. A big selling point for us, we do consider applicants in probationary periods. So we've done a lot where people have only been with the company for a week or so, and they've just moved for more money. This is obviously back when times were good. I'm not talking about recently, but before the pandemic, a lot of people were moving around, just getting better jobs. And a lot of lenders were reluctant to lend for 6 months. We will do it straight away as long as we can see a copy of the job contract to show how much they'll obviously be earning. We take into account income from second jobs, overtimes, bonus. Now, talking here, this is quite an old bullet point, this one. At the moment, we have to be careful with bonuses and overtime because we're not quite sure what's going to happen in the foreseeable few months. So at the moment, we're taking just really normal income, your statutory, your basic income, is what I'm trying to say, plus anything they get on a regular basis. So if they get London waiting, maybe some regular bonuses, I don't know what they would be, but something that's not based upon sales or anything like that, we'll take that into account. I think that's the same as what most lenders are doing now. We also ignore buy-to-let mortgage payments if they're self-funding. So we probably ask for an AST as long as that covers the mortgage by 100%, then we will be happy to ignore those mortgage payments. Okay. Hope you're okay. It's funny, I can't get any feedback, but I'm sure if any of you got any questions, by the way, I've got a little section at the end for questions. Here are the rate charts that you all have there. Not going to spend too much time on these because I think they're fairly self-explanatory. There's a rate chart that's got with ERCs and without ERCs. This is obviously the without ERCs. So there's 3 plans there at the moment: a 65% loan to value plan A, 70% and 75%. The only thing I generally get asked on these, which confuses some people, is why is there an option 1 and option 2? If you look on that variable rate there, so I've got variable 2-year fixed, 3-year fixed, 5-year fixed, and you've got an option 1 and an option 2. Well, the first thing you can see there, option 2 is a minimum loan of 100,000. So it's a slightly better rate for higher size loans. Our average loan size, by the way, is about 77,000 currently. So it's fairly high. And also the difference between option 1 and option 2 is the lender fee that we charge. So we call it product fee. So on option 1, the product fee is 495. On option 2, 0.65%, minimum 795. So that's the difference between the 2 plans. And that's the same on the fixed rates. You've got option 1 and option 2. And then up here you've got option 1 and option 2. So you can basically choose to have a slightly lower rate with a slightly higher fee. And to all intents and purposes, it works out exactly the same. It just really is there to make customers happy on what they actually want. Some people will accept a slightly higher fee. Some people want the very lowest rate. Okay. So I'm not going to spend too much time on the second one of those, which is the with ERCs. Suffice to say that down here you've got the redemption charges. Don't you see on the variable rates, as I said before, it's just 3% of the first year, 2% the second year, and thereafter it's nothing. So although it says without ERCs, if they've got a longer term in mind, then obviously they won't have any ERCs after a couple of years. Okay. And the other thing I want to mention on here is that the lowest rate in the market currently, 3.37, and this is what you might see banded around when you look at any kind of literature on second charges, or you look on sourcing systems, you will see that no one is advertising a lower rate than 3.37 at the moment. So if it's a rate the customer's after, should be really considering Paragon for second charges. Okay. Slide 8 of 12. I haven't got loads. I'm going to be another 5 minutes, so hopefully you're still learning a bit. Valuations here. This is just to mention, as I did earlier, that we can do AVMs quite a bit now. So the maximum loan we, as you saw earlier, we do is 75%. If it was anything over 70%, they would have to have a full internal valuation. But below that, you've got an automated valuation model up to 70%. And this is the table. So those of you that know about AVMs, you'll know there's a confidence level that has to be achieved on an AVM for a lender to accept it. And these are the confidence levels on the certain property values there. But all I would say on that is we're doing more AVMs than ever before now. So that means that sometimes your customer doesn't even have to pay for a valuation, which is great news. Okay. So in conclusion, I've got a couple of slides. In fact, I think there might be, I think there's 2 and then a question slide. Just to give, because people say to me, Nick, I know, I hear what you're saying about second charge, but where would I actually use them? And there are various scenarios, but I just thought I'd give you a couple of scenarios we've actually done in the last 6 months. These are real customers. So this customer, this particular one, wanted to buy some land in Corfu to build their dream holiday home. I think they were Greek extraction, the customers. I seem to remember the case quite well. We collected the evidence from the sales particulars, that kind of thing, and some plans, the memorandum of sale. Obviously qualified on their income, but because they're securing the the second charge on their property, it was in London, this particular one, then it was quite straightforward. I think it completed. We were able to release the money within about 3.5 weeks. And this was about 6 months ago. I haven't spoken to the customers recently, but I spoke to them about 3 months ago. They're on their way out to Corfu for a little recce to see where they were going to be building. So quite an unusual one, but it seemed a lot easier to do it that way than any kind of foreign currency mortgage, that kind of thing. And a bread and butter one to finish here, consolidating debt to help fund home improvements. So a lot of our customers, as I said earlier, do take the monies to consolidate credit. At the same time, they may want to finish off some home improvements or something like that. And a lot of what we do is for home improvements anyway. But this particular one, they were actually consolidating £10,000. Oh, they wanted £10,000 towards the home improvements. That was it. And then the other 35,000 was to consolidate credit. And once we've consolidated that monthly credit, I think it only put their monthly payments up by about £17 a month. So all intents and purposes, they were getting £10,000 for their home improvements, only paying £17 a month extra. Albeit, they were putting it over a slightly longer term, but they were putting all their credit into one. The art there is obviously not to then run up credit again thereafter. But that is our bread and butter, and that's what most of our 90% of our cases are for: consolidation with a touch, or home improvements with a touch of consolidation, or the other way round. Okay, so that's just a couple of examples. Oh, there is one more. Okay, this is just extensive home improvements. So this was this particular one. I seem to remember they'd taken remortgage and hadn't budgeted enough, which I'm sure you've heard that story before, and needed £50,000 to finish off extensive home. It was they were building a basement, and run into trouble in London somewhere with some gas mains or something. Cost them a lot more. Anyway, they came to us on a second charge, and we released the monies, this one, within 3 weeks. So it really helped them out, and that's the kind of thing we can do. So, in conclusion, what I would say is second charges aren't difficult. They are now a viable option to a first charge, and I think really it is in your toolbox to make clients aware that those products are available. So I hope that helps. Any questions at all?
Okay, Nick. Yeah, I can see one. I'll read them out, Nick, just in case.
Oh yeah, okay, Tony. Yeah, okay, Tony. Thank you.
I'm back in the room. No techie issues so far for me. So Nick, is the 3.37% just for regulated second charges? Are you doing seconds on buy-to-let?
Very good question. You think we would, wouldn't you, really? Because we got a large buy-to-let first charge operation. No, unfortunately, we only lend on residential properties on seconds currently. We might, well, I've been saying for years we might be going. It's a systems thing, really. So at the moment, the answer to the question is it's just on residential second charges.
Okay, we do, by the way, Harry, have other lenders that will do second charges on buy-to-let. They're gradually coming back in dribs and drabs. I think we currently have some products to 85% LTV. That particular lender I'm talking about is actually presenting at next week's show. So if you want to be a part of that one, obviously, and see what he's got to say, they are more expensive than Paragon, because Paragon are, 3.37% is as cheap as you're ever going to see in this marketplace, I think. But then I said that the last time they had a low rate, and then dropped it again, Paragon. So, Tony Silver's asked, Nick, are you my BDM in the City of London? Also, are you doing AVMs on first charge mortgages as well? Tony, just be aware that Nick's on the second charge side of things. He's not involved with the first charge buy-to-let side. Because Tony said, I've heard that AVMs are being highly downvalued by an RICS surveyor. What's Paragon's view, please? I don't know if you can answer that, really, Nick.
You're absolutely right. The way Paragon works, we've got separate teams, BDM teams for first and second charges. I am the BDM for second charges for London. As regards AVMs, our AVMs are all done through HomeTrack. I don't know about AVMs being downvalued by Rick surveyors. Don't get involved with that side. Tony and SFS have got access to Home Track, and any AVMs would be done through the Home Track system. I think that's fair to say, Tony, is it not?
It is, yeah. And we can normally get them done with about 30 seconds as well. It's a very, very quick process. Harry's asked a question, but I'll actually answer this one, Nick, because a client has no mortgage and is totally refurbed property. Just be aware, Harry, that Paragon on this side, it's second charges. So there has to be a first mortgage in place. So yeah, they can't do unencumbered properties, unfortunately, on this particular side of things. If it's anything to do with the buy-to-let side, they could possibly, but then if it's refurbing the property, but if he's short, you're then probably looking more at a bridge than what Nick does. So, okay, a couple more questions. I will rush through these because we are slightly behind time, but we seem to have sorted out our techie issues with Mike Davies. So we're going to get him to go. He might appear again in a moment, hopefully. So Mike, if you can switch on your camera and video, and I'll just ask one more question of Nick. Can you explain your stance re furlough customers?
Yes, I can. If a customer's been furloughed and we know that they've been furloughed, we'll lend up to 70% rather than 75%, and we will ask to see a payslip that shows that they're back at work.
Okay, Nick, thank you very much. So we're running about 7
Thank you very much
behind.
indeed, everyone. Thanks for your time.
Great stuff as always. Thank you very much. So I don't need to introduce Mike because I've already done that. So what I'm going to do, Mike, go straight onto your slides. Mike, can you hear us? I can see you.
I can hear you fine. Hopefully you can see and hear me now, Tony.
I can see and hear you absolutely fine. So I'm going to put your slides on, go over to you, and there you go. You've only got 7 slides, and one of which I did last night. So there you go. It's all yours.
Excellent. Thanks, Tony. Good morning, everybody. Apologies for the technical issues. I'm pretty sure that was probably all my doing, but online now, and hopefully no more challenges. I thought today we just focus on our buy-to-let product range. As Tony mentioned, we do look at commercial investment and owner-occupied loans as well, but I wanted to keep the presentation pretty compact. So we're just going to look at our buy-to-let range. Before I do that, a bit of background about YBS Commercial, where we've come from and where we hope to go, because Tony mentioned in the introduction, excuse me, that part of my role was to work on the growth plans that we have. And to understand those, it's probably worth understanding a bit of the history. YBS Commercial Mortgages is a rebrand of the old NMP Commercial Mortgages, the Norwich and Peterborough business. It became part of the YBS group actually back in 2008 as part of a restructure during the financial crisis, and traded under the NMP brand for 10 years, pretty successfully, very much focused on the east and southeast of England and London markets, kind of driven by location, and there was a big and successful team there. In 2019, the YBS group started to look at ways of potentially expanding the business, looking for new areas of opportunity, and commercial was the obvious way to go. The rebrand just sort of brought the logo and corporate identity back in line with the rest of the group. But what we also did was invest in 3 new hubs. So we've opened offices in Bristol, Birmingham, Manchester, and brought in a new team of lending managers to give us a much more broader approach to the country. So a lot of what we've done in the first 6 months of this year is really start to embed those people into those offices and into local communities. And we've also grown our broker panel as a consequence as well. The panel was reset in 2019. There were previously 600 firms that were on the panel. They were taken off that panel, and we've built the panel back up to 100 names. And that is one part of our strategy that we're currently looking at in terms of how many brokers will work for what we're doing in commercial, because what we are not trying to do is build a real mass market, compete with everyone business. We're looking specifically at areas where we can benefit particular types of borrowers, and I'll cover that when we start to look at the buy-to-let products. As well as the buy-to-let, I mentioned the commercial investment. that again is, I hesitate to say we want to be a specialist lender because that sort of discounts you from certain parts of the market. But there are probably specific types of borrowers that would be interested in the sorts of products that we offer. And they tend to be larger, longer term investors. And that's a theme that runs through all of our USPs. We're not really a short-term lender. So we don't offer bridges, we don't offer development finance. And that's a deliberate move on our part. One of the things that YBS is looking to do is build a long-term relationship with our borrowers. The maximum term that we can offer on commercial investment goes up to 25 years. And we're very happy to lend that sort of money. And we are increasingly being asked about interest only and longer term fixed rates on commercial investment. You'll see in a sec that we do that for buy to let. And that commercial investment range is likely to be enhanced as we go through next year. But if you do have clients who are looking at commercial investment, probably the best thing to do is pick up the phone, drop me an email and talk about their specific requirements. Because whilst we might not provide the solution that they're looking for now, there is every chance that we will within the next 6 months. And you'll see in the buy-to-let range that things have changed quite radically since we relaunched, and certainly from January. On the buy-to-lets, at the start of the year, we offered a single base rate linked product, and that was it. That was all you could get from us. Since then, we've launched a range of fixed rates and some specialist products around personal buy-to-let borrowing or larger personal buy-to-let borrowing, new build flats, and also most recently holiday lets. The other thing I should mention to give what I'm going to talk about some context, obviously Accord is part of the YBS group, and there is no crossover between the products that we offer and Accord. It wouldn't make any sense if we did that, because Accord has got a well-established model that works really well on the residential side, but also on the buy-to-let side. So there's no competition or overlap between what we do, and we're really, really clear about that. And some of the inquiries we get, we do look to pass across to Accord, and sometimes business comes the other way as well. So that's sort of where we are. It's where we see ourselves in the market, and it is still very much a growth and change story. And it's been an interesting 6 months, to be sure. I think, you know, Tony and Nick both sort of referred to what's gone on with coronavirus and people working from home. All of our teams have been home based since March. Despite evidence to the contrary, we've been pretty successful in terms of adopting new technology. Microsoft Teams is the platform that we use, and so far things have been going pretty well. We did see a significant fall off in business through April. I think everybody had the same experience. But since then, June was a record month for us in terms of applications, and the July figures came out last week, and we actually had more volume of applications again through to July. And I think there's a number of reasons for that. We've been very clear that we are still open for business during the lockdown. We did change our criteria. We pulled back on LTVs. We got a little bit more strict on debt servicing. But that again is being slowly eased. A month ago, we increased our LTVs for our buy-to-let range, and earlier this week, we increased the LTVs on commercial investment as well. So we're looking to get back to as close to business as usual as we can get in a shorter time period as possible, to keep on lending. So let's start to move through the slides. This is the second test of my technological abilities, and thankfully I've been able to change the slide, so I'm starting to feel a lot better about myself. I mentioned at the start of the year that we just had a base rate tracker product. We launched the 5 and 10 year fixed rates primarily in response to a lot of broker feedback that we were getting that the base rate tracker product wasn't really fit for purpose. It wasn't what people wanted. But we also looked at a number of different terms, so 2-3 year fixed rates, and that didn't really fit with what we wanted to achieve in terms of the brand, our USP, and providing long-term solutions for our customers. So we went for a 5 and 10 year fixed rate product. It's fair to say that the 5-year fixed rate is by far and away the most popular in terms of applications that we get. But for borrowers who are looking for long-term stability, the 10-year fixed rate does offer that. We've seen an uptick in the number of applications that we're getting through for the 10-year fixed rate. And that has been more noticeable since, not straight away, but through June and July, that product has become more and more popular. We expect to see a further increase in applications for the 10-year fixed rate. We've actually made more money available in terms of the cap for that fixed rate. So it will continue to be available through into the start of next year. We did bring a slight price increase in at the start of lockdown, but that doesn't seem to have deterred people at all from applying for it. I don't want to run through the specific criteria, but if there are any specific questions, ask me after, or I think my email is available as well, so drop me a line directly. The one distinction I would point out is there is a difference in LTV between new and existing customers in terms of the LTV and the maximum loan that's available. We define an existing customer as somebody who's had a 3-year relationship with YBS. But again, we're not seeing that as a real barrier between people looking to make applications and our ability to lend on that. Great. Large personal buy-to-let for us is a real significant evolution of our buy-to-let range. We've always focused on limited company buy-to-let. It's a big differentiator between us and Accord, but it also works in terms of how our systems are set up. To move into a personal buy-to-let, it's a systems change for us, but it's also a different type of borrower, which might sound a little strange, but this is real new territory for us, and I think it's an indication of what we're looking to do in terms of our willingness to expand the product range and innovate and bring new products to bear for our brokers. And again, a lot of the driver for this came from feedback we were getting from the broker panel, but also the way that we saw the market start to evolve. Differentials here, the minimum loan size is far higher than what we would normally look to do. For all of our buy-to-let products, it's a minimum deal size of $500,000. Here we're looking at 1.5 million up to 6 properties, or 3 million for any portfolio size. We've actually seen a fair number of these deals start to come through. They tend to be focused in the southeast. I'm not sure if there's any particular reason for that, because all of the regions are able to provide this product. We think it's because of property values down in London and the southeast. But again, it's proven to be pretty popular. Fixed rates are still available for this product, and the broad strokes of the package remain the same. What we really want to do here is not put anything out in the market that's going to start to compete directly with other personal buy-to-let lenders, and I think that the size of what we do from a minimum deal point of view is what we're really looking at. I'm not sure what's happened with my slide there. If that was me. Yeah, sorry about that. I think that may have been me messing around with the slides again. Just keep moving on. Okay, new build flats. This was our first specialist product that we launched. One of the challenges that we've got here, and I don't know if there's going to be any questions on this product, is the sort of concentration challenge that lending to blocks of flats brings. We've limited ourselves to 12 units, and what we found is that this is one of the biggest challenges, surprisingly, that we get with this product. Quite often there are more units that borrowers look to get funded, or the block itself has got more than the 16 units maximum that we've got in the product spec. Again, so far been very much focused on London and the southeast, and what this product isn't is linked to HMO. We don't at the moment have an HMO product, although it's probably the next thing that we're looking to launch. We are reluctant here to get involved in office conversions, which again is a large part of this particular market. And with what's happened recently with home working and people potentially not going back to offices in the near future, there seem to be more of these deals coming through. It's not something that we're looking to change in the short term, but if there was something that I'd ask for from the audience is feedback on that, whether or not office conversions are going to become more common, whether the quality will go up, because quite often with the office to residential schemes that we've seen, they're either not in great locations, or the units are pretty small. I think there was some media comment recently about some of the changes to the planning laws and what that might mean for office to residential conversions, and there seems to be a trend towards smaller units in offices, which is again isn't where we want to be, but I think it's something that we need to keep under advisement. On to the next slide, which is holiday lets. This one's really interesting. Only recently launched. We delayed the launch. It was due. It was actually due to come into effect at the end of March, but obviously as the lockdown started and it looked like nobody was going to be going on holidays anytime soon, we held it over and launched it in June. We've actually run this product out of our Southwest office. Al Griffiths, who's the regional director down there, is leading on this for us, and we focused it primarily on the Southwest and South Wales coasts. We were uncertain whether or not there'd be a lot of demand for this. Staycations were obviously flavour of the month, but we were uncertain that investors would want to get involved in the market and look to commit to either buying new properties or look to refinance portfolios based on the uncertainty in the market. It's fair to say in the first week, I think we had over a dozen inquiries, the majority of which look really interesting. And we've actually got the first deal under this scheme underwriting this week. And demand has continued to come in, and it's been pretty consistent. I don't know if any of you have tried to book a UK holiday or a UK break recently, but everywhere seems to be pretty much booked out. So that's been really good to see, and really positive. The pay rate here is significantly higher than our other products. One of the reasons for that is everything else that we support in our buy-to-let ranges needs an AST. Here, obviously, that's harder to do. We look for some evidence of past experience and past performance for the property, and again, it's been really pleasing to see that the deals have come through. That's something that's been able to that affordability calculation has been met really easily, and the rate doesn't seem to be deterring people. So again, that's something that we will keep under advisement. But I think 3.85 on a 5-year fixed, where there's no AST is a pretty good rate. Interest only is available as well. So we expect to do a lot more lending under this product than I think we'd initially expected. So that's been really good to see. And I think with holiday lets, it's probably going to set more of a trend for us, where as well as the fixed rates, which certainly aren't going to go anywhere, we are going to look at more sector-based lending, either in the buy-to-let market, or when we start to move into more of the owner-occupied SME market. That SME lending for us has dried up pretty much completely this year. Even at the start of the year, we weren't seeing a lot of deals coming through, but clearly with the impact on SMEs, there's been big focus on C-bills, bounce back, and basically I think battening down the hatches. As a property lender, there are certain sectors that we can't really support directly, but certainly again in the last few weeks and last few days actually we've seen some more applications start to come through. Hotels, again, I think this is linked to what's happening with holiday lets, have made a reappearance. We're also starting to see some more healthcare deals come through the door. Maybe looking at refinance, which again is interesting to us because there's a bricks and mortar asset behind it, and I think that is probably another area that we're going to look to expand on in terms of where we put our new product development. On to the next slide. In terms of maximum exposures, we are really interested in larger size deals. I mentioned our minimum deal size is $500,000. We've increased that through the year. We started off at 100,000 as deal minimum. We stepped up to 250, and we've gone to $500,000. The reason we've done that, and you know, it's best to be candid, we don't have a particularly large team. We've got 13 relationship managers or BDMs in total. Our systems are designed to manage risk that the YBS Group is happy to take on. So we are looking for the best credits. I know there's a range of lenders out there who will look at borrowers with maybe not the cleanest of track records. It's better to be honest and call out that our risk processes are pretty demanding. So in order for us not to disappoint people, we're not looking to be a sort of large volume lender. These limits have increased recently, and we are seeing more large deals come through, and that seems to be a better fit for us in terms of how we can manage deal flow and meet expectations. If you are looking for a quick turnaround deal, but by all means talk to us. But candidly, our process from application to completion can take somewhere between 3 and 4 months. We are working on ways to improve that and speed that up. But I'm certainly not going to sit here and say definitely come to us. We're a quick turnaround lender. That's not where we put ourselves, and that's why the both sort of floor and ceiling are starting to increase. And again, as with everything else, as the business starts to grow and develop, and we get more market feedback, we're going to make sure that we keep an eye on where those limits sit. And hopefully, I've kept my time, or Tony made up some of the time that I managed to lose at the start.
We've tracked a bit back, Mike. Yes, we have. So we've got a couple of we've got one question from Tony Silver. That's pretty much the same as one of the questions that we already had that was pre-prepared. So Tony's asked, Mike, I'm a founder member of FIBA, but can't gain direct access to YBS. Are you able to help, please, as I resist using a packager? Thanks, Tony. Well, you can answer that, Mike, obviously, because you can say what your policy. I know how difficult it was to get on the YBS panel, and we were invited. So I'll let you answer that, because the next question was, what is the process of progressing a loan through YBS commercial mortgages?
Yeah,
so,
absolutely. So yeah, thanks for the question, Tony. It is a really current issue for us. I mentioned about the size of the panel. It's the panel size is something that we've opted for a couple of reasons. We want to be able to manage deal flow. I mentioned at the end there about our capabilities, and I think we need to be really honest about that. It is something that we are looking to improve, but if we had a really big panel, I think we just end up disappointing people. That said, we are looking to take brokers on. There is capacity to do that. So Tony, I think it'd be good if we could pick up offline and have a conversation about that, because one of the first things that we did was actually speed up the broker onboarding process. I can't remember, Tony, if you had to go through the old process. If you did, apologies for that.
It was lengthy.
It's not now.
It was like applying to be FCA authorised, to be honest with you. At some stages it was, but then we was in the middle of lockdown, so I realised why it was lengthy. So
yeah,
just about the FCA. That was another lender that we use. Wasn't applying to the FCA. So, Tony, all I could probably say is, you see, I tried and failed. We're more than happy if someone's putting business through us and we're packaging it and we can see that it's of decent quality. I'm more than happy after a while to do a warm handover to a lender like YBS, and you can then go direct. So, because they want to see the quality of the business, obviously, and if it's a recommendation we can make, more than happy to do so. You'll find out probably more in my second presentation in a little while why we do stuff like that. Because for me, it's not just about the next quid I can earn; it's about ensuring that people that use us are profitable and in this for the long run. Because if you got directly with YBS, you might still then think, okay, I can use you for second charges, I can use you for maybe a lender that comes out gives us an exclusive, anything of that nature. So.
Yeah.
Okay, one more question I've got is, does YBS Commercial Mortgages have plans to extend its product range?
We do. On the buy-to-let side of things, HMOs is under active consideration. We perceive HMOs as a riskier market than the others that we're in for the buy-to-let product in particular. But we're also aware that there are, there are investors out there in the HMO sector that would fit with our ambitions. I think the one thing I would say, and what we're unlikely to do, is provide an HMO product where the investors are completely reliant on HMO income, either to service their debt or for what would happen in the event of a downturn. So, maybe mixed portfolios with an element of HMO is where we're going to position ourselves with that. But it is one that we're having some fairly interesting conversations with our risk guys about. Certainly, commercial investment, the range is pretty simplistic at the minute, and we're looking to expand that. Longer interest only terms, I think, is absolutely one area, and definitely more longer term fixed rate, 5 and 10 years. I think is inevitable, Tony. Whether we go longer than that, that's a discussion with risk and finance, but I think there's probably some demand for that on larger scale facilities.
Okay, thanks, Mike. But from my point of view, YBS, great lender to have on board. We was with them at Norwich and Peterborough up until last year. Then got the letter saying that rebranding, they were basically sort of going into hibernation for a while. But when we then got the call to say we're coming back, and would you like to come back on board? It was probably one of the highlights of lockdown for me. There wasn't many highlights. One of the few highlights we actually had. So, and we're now actively using them. They won't take rubbish business. They're looking for quality customers, but there's still plenty of those out there. So, and they're a great lender to have on board. So, Mike, thank you for your presentation. Much appreciated. We are running about 5 minutes ahead. So what we'll do, everyone, is I'll put the next slide up, which is we'll come back about 11:30. Just allows everyone to have a toilet break, coffee break, whatever break you need. And we'll come back at 11:30 with our next presenter.
Thanks, Tony. Pleasure.
Okay, everyone. So within the stuff that we sent you, and I've now sent everybody, we've even had somebody sign up about 10:30 today. So you would receive the semi-exclusive products that we have with Family Building Society. We are now an accredited packager, and we're very excited about that. And you also received the decision in principle forms for both residential, which, as you can see, Darren, you've not seen these. We've actually personalised these so that it's exactly and looks nice and tidy, nice and neat. And we've done exactly the same on the buy-to-let as well. So this is all basically they need to give a decision in principle on a case. And it's got everything there that you pretty much need. Okay, so a little bit first of all on Darren when this comes up. Darren's been in financial services for 31 years, working for high street lenders, specialists and specialist lenders. And during this time spent a number of years as a mortgage underwriter and also a mortgage advisor. Has been working as a BDM for the last 7 years and been with Family Building Society since 2016. Married with 2 kids, extremely passionate about socialising and sport in that order. The golf bug has really bitten him over the last few years, and this is something that takes up quite a bit of his free time. I'm now retired from golf, unfortunately, but that was at the request of every person I ever played with, because I was officially the world's worst golfer. That's true. As far as his interest in fact, and this is a bit of a scary one, to be honest with you, Darren was visiting New York at the time of the Twin Towers falling in 2011 and was actually inside one of them the day before they fell. Lucky escape indeed. Sometimes you just think, what if? That could have been absolutely horrendous. So, but he is still with us, as you can see. So I will just put his slides on in a moment. And Darren, over to you. You can turn your mic on back on now, Darren. So I'm not going to say anything else.
Okay, thank you very much, Tony. Right, so thank you very much. Yeah, so Darren Deacon, I'm the senior account manager, one of the senior account managers for the Family Building Society. I actually look after the Midlands area, and I've been with the society now for the last 3.5 years. I just briefly want to cover, I know we've got about 20 minutes or so, who we are for those of you people that do not know who we are, what our general criteria and USPs are, where we specialise in certain areas of lending, and obviously so any questions that you want to ask, I'm sure I'll be able to take those at the end. So for those of you who maybe go back a little way, we were formerly known as National Counties, and we rebranded some 3.5 years ago now to Family Building Society. Our aim is that we are looking to help first-time buyers and also applicants that go into their 90s. So we are known as a later life lender, but we are doing very much and a lot at the moment, particularly with first-time buyers. We've got 1 national accounts manager. We've got 6 BDMs that sit amongst the region. So there will be a BDM to cover all of the advisors, all of the brokers that we deal with in England and Wales. As I said there, the main areas that I will be covering off are lending into retirement, interest-only lending, buy-to-let, which includes a lot of expat lending, joint mortgage sole proprietor, and also the family mortgage, which is a 95% mortgage, which we are getting a lot of interest on at the moment. A bit more background to us. The main thing is that we do not credit score. We manually underwrite every single case. As we say there, we try and adopt a common sense approach. The reason you're going to be using and looking at us is that it's a case that is not going to fit with the high street. So the high street lenders are pretty much, they're looking to run it through a credit scoring system. If it falls out of that, then it's more likely that you're going to be wanting to speak to us. Every single BDM that covers your area will talk to you about your case individually. They are all experienced in being able to understand, obviously, what our criteria is, and also help you place that case and discuss that scenario with you, bounce the ideas back and forwards, and ultimately get that in front of an underwriter, which is the key thing, because at that point, the underwriter can look at your decision in principle and give you firm agreement that, based on the information we've seen so far, that the case is likely to proceed. We do not have a maximum loan size, so no worry about any larger loans. Then you can talk to us about that. We offer free valuations up to $500,000 and $250 cash back on completion, and free in-house legals as well. So one of the main areas of lending for us is certainly lending into retirement. We can actually lend up to age 95 on a repayment basis. So many of the cases that I and my colleagues see are from high street customers that are in their mid to late 60s, and those customers are coming to you guys and saying, the high street lender want me away, they want me off our books. They may be feeling at that point that the only alternative for them is sale of property or equity release. Now, sale of property might not be the right thing for them. They might not want to do that at this moment in time. An equity release might not be something they want to enter into either. It might be that they are too young, or that they simply can't get enough equity out of their house. So, as I said, we are happy to take those people well into retirement. So we will take their earned income up to the age of 70. Now, there is a slight caveat to that. If you do have a professional, maybe a doctor, a lawyer, someone like yourself, a financial advisor, then we can take that earned income to 75. But in a normal job, bog standard job role, we are going to age 70. So how we help these people go beyond the age of 70, maybe help them switch that interest-only mortgage and bring it onto repayment mortgage, is that they will have pension income, which will be state pension, private pension, even large pension pots. We get many, many customers who've got a large pension fund that they may not have even realised yet. Then they're not taking anything from that, but we are happy to do that. If we can get sight of that pension pot, we can see the value of it, then we are happy to use that, and we could underwrite the case on the proviso that they would take that money out of that pension fund. Other people that we see a lot of more recently are limited company directors as well. You might have a customer who are in their early to mid 70s, and they're still involved in the business, but it's not a business that they are involved in on a day-to-day basis. They have handed over the effective control or that day-to-day management of that business, maybe to their sons or daughters, or a full management structure. We are happy to take that dividend or that salary from these customers as long as we can get confirmation from the accountant that they are not involved in the day-to-day running. We do not want to be forcing these people to go to work in their 70s on a day-to-day basis, but we are happy to take that income if we can find that they are not hands-on. Other income streams as well are rental income. Many have got property. If they declare that rental income, we'll happily use that along with their pension income, etc., and even investment income as well. So interest only often goes hand in hand with a lot of later life lending. We can actually go up to 75% with a repayment vehicle in place on interest only. But I would say, well, obviously the vast majority of cases are downsize and sale. So if that is the only exit strategy that your customer has is downsize and sale, then we can go to a maximum of 70%. Now, interest only is a very, very flexible criteria for ourselves. We do a lot of business in this area, in that we do not have a minimum income for a downsize. So they don't have to be earning £50,000 or £100,000 a year. We are not looking at that. They need to have an income that is enough to support the mortgage. We do not have a minimum equity either. So equity-wise, we're not looking that they've got to have 250,000, 300,000, etc., etc. They simply have to have enough equity in the property in order for us to be able to evidence that a downsize will take place. We can also stress on a pure interest-only basis for 10 years and less. Many people are unencumbered and are wishing to capital raise money from their property. Many are gifting money away to children and grandchildren. So that's another area where we can assist. So it's not just for a purchase or a remortgage. It is for unencumbered, where they might want to be raising it maybe for a holiday home or second home, as I say, or gifting money away. As you can see there, we can also help the self-employed applicants. We will also, if necessary, if they're not taking all of their net profits and they do leave profits behind, then we are more than happy to look at that as well. We'd simply need 2 years accounts. We can send that to an underwriter, and the underwriter would be able to ascertain how much is left in that business and what could your customers actually take over and above what they already take as a salary. Expats. We do a lot of expats, and it really is an area where Tony and his team can help you, particularly on expats for buy to let and also on the interest-only residential side of things with their semi-exclusive fixed rates. We do a lot of expat buy-to-let. So a straightforward case for us is somebody that has got a UK passport, they're living and working overseas. We have in and around 45, I believe it's 50 countries now where an applicant will be living, including Australia, which is a tough one to place, America, Europe, Middle East, New Zealand, Canada, and many, many other countries beside. So your applicant is living and working overseas. They could be self-employed in a lot of the locations or employed. They simply have a property here in the UK that they wish to remortgage. More often than not, it is their residential property that they got on a consent to let. The existing lender now say you need to formalise this maybe onto a buy to let, and or you're right now overseas. They're not willing to assist. We are happy to do that. So we want them to have a mortgage here in the UK because we're going to have a very, very limited track record on these people with them living overseas. So a remortgage of a property is absolutely fine. Capital raising on that property is fine. Buying further buy-to-let is absolutely fine. We treat an expat buy-to-let in very much the same criteria as we would do a UK landlord, in that we do not have a minimum income. We do not worry ourselves if they've got a number of properties in a portfolio either. So they can have any number of properties in the background. We're more than happy to assist. Just trying to move the slide. Right, okay. A real popular product at the moment, and I'm sure you'll all agree, is trying to get a 90-95% mortgage. We relaunched our family mortgage about 3 to 4 months ago, and it is just flew. So what it is what you can see there. It's a 95% product. It's a 5-year fixed rate at 2.99. Now, it's not an off-the-shelf, straightforward 95% product. It runs along the lines of the Barclays Springboard product. Now, we've had this product running for around 5-7 years or so now, but it's getting more and more traction, obviously, because it's difficult to get these higher LTV cases placed. So if we're taking it at the extreme there, we would take a 5% deposit. And then what we need is an additional 20% security from a family member. Now, that could be any family member, the wider family, not just mum and dad. But I would say the vast majority of cases are always going to be mum or dad. So we would take a 5% deposit in the normal way. That can be gifted, it could be saved, whatever the case, but it's a 5% cash deposit. Now we then need a further 20% security, which we could apply, let's say, to mum and dad's property. So it's 20% of the purchase price of your applicant's property. We will put that charge against that property. Now that can sit behind any existing mortgage that they've got, or even a second charge. We could sit as a third charge if necessary. They do not have to be unencumbered. We are not underwriting the parent. We are simply putting a charge on their property that is the equivalent of 20%. So we're not worried about their age, their income, or any adverse. We are simply putting a charge on that property. The charge will remain there for as long as we have the mortgage, up to a maximum of 10 years. In reality, what will happen in all of the cases that we've done so far, at the end of the 5-year term, you will revisit your customer and they will go to the high street when they're hopefully sub 90%. There's a bit of increase in the property value, etc. They are no longer a first-time buyer. They can remortgage away. Once they remortgage away, we'll get our cash back, just in the normal sense, and we will remove the charge and everybody moves on. If the parent has cash, an added feature to this is if they have the cash, then we can take the cash. So rather than putting a charge on the family member's property, let's just say the parents do have the cash. Now, it may be that they're happy to hand over that cash, but it might be that they might want to see that cash back at some point. So they don't think, oh, I want to gift all that money away, even on a promise like, well, I'll pay you back sometime later, Dad, which may not ever happen. It might be that they've got other sons and daughters and thinking, well, I can't treat everybody the same and hand over 40, 50 grand, whatever that 20% is the equivalent of. We will hold on to that cash. We will ring fence it. That is secure. Nobody can access it. It's not sitting in an account that anybody can touch. But the key benefit to us taking the cash is that we will hold on to the cash and say to the family member, do you want us to pay interest on this money, which we'll pay at around 0.5%, which is normal high street rates. They may say, well, 0.5% is not worth much to me at all. I'll allow you to offset that against my son or daughter's mortgage. So whilst we're holding on to that cash, if they go down the offset route, we can offset against the son or daughter's mortgage balance. They will then obviously get the benefit of the offset. Do they want to overpay? Do they want to underpay? So that really is a key feature to that. The final thing as well, just if you are speaking to mums and dads about this and they're a bit concerned about handing over the cash or obviously putting a charge on their own property, we as a society will offer a 6 months unemployment cover policy effectively, in that if either applicant was to lose their job through no fault of their own, we would pay the mortgage for up to a maximum of 6 months. So it just gives the parents a little bit of peace of mind, maybe. Another area that where we assist, particularly well with first-time buyers, but not just exclusively for first-time buyers, is joint mortgage, sole occupier. Often joint mortgage, sole proprietor, it's all the same thing. It's just we just term it slightly differently. So this is where you've got a customer that has fell in love with a property, but they're just falling short on income. They're a good way to be doing it on their own, but they just need a bit of parental assistance to tip them over the line. So yes, we can bring that parent onto the mortgage. It does have to be parent, son-daughter relationship. Parent goes on the mortgage. Now, I know that there's a lot of lenders who will offer this product, but where we win a lot of business is through our later life criteria, which I spoke about earlier. So let's just assume that the parent is in their mid-60s, 60, 65. Remember that we can go all the way out to age 95. So it might be an example where you've got a parent who is 65 looking to help her son on the property ladder. We only need a little bit of pension income, hopefully, just to tip that over the line, just to make it affordable. But often by adding a parent onto the mortgage in this way, the term is going to be dictated by the eldest age. So as we can go all the way out to age 95, a 30-year term for a 65-year-old is possible, thus giving us the ability for that customer to make it more affordable. It's a 75% product. So as we all know, we can bring the parent onto the mortgage, but they're not going on the title deed, so there's no additional stamp duty for them to pay. We do like the applicant, which obviously the child or the grown-up child in this case, to be earning in and around £20,000. It's more to say to steer away from people that are maybe students, maybe working part-time hours, 16 hours a week, topped up with tax credits and the like. We want to see that they're earning in and around that £20,000, but they certainly do not have to be professionals or anything of that nature. The other thing as well around this is that we can also, and we have done cases where children can help their parents. So it works in exactly the same way. So you might have an older a parent who's left with a mortgage and hasn't got the ability to pay that mortgage. So their children can help them in a way and add themselves to the mortgage and keep mum in their own property. In exactly the same way, they're only going on for affordability. They've got no reason or want to actually move back into the house or go onto the title deed or anything like that. It also helps with people that are separating. We do lots of that, and where people are separating, some party leaves the mortgage, and whoever's left behind hasn't got the income to support that mortgage. Usually by definition there, if they're bringing their parents onto a system, they are that much older, the applicant's older, therefore the parents are older. But remember, we can go to age 95 on that repayment basis. very, very briefly, coming up to me 20 minutes or so now, we deal with offset mortgages on residential and buy-to-let. I think offsets, yes, were very popular some time ago on residential, but very, very few. In fact, I believe there's only 2 lenders other than ourselves that would offer a buy-to-let offset. Great for those portfolio landlords, as I said earlier on. They have no restriction around a portfolio landlord. We don't get involved in aggregate debt positions, higher lower tax brackets, stressing a portfolio, worrying about how many you've got in the background. But very, very often, you've got a portfolio landlord who's got a slush fund, they've got money that's set aside. Why not bring one of their properties out of their portfolio, bring it to us, drop cash in the offset account, and actually offset that mortgage balance with whatever loose funds that they've got. They could even pay their rent into it. You could have people that are self-employed, maybe putting money in cash into that maybe to pay that tax bill at the end of the tax bill, at the end of the tax year. So a buy-to-let offset is quite a unique product, but also, as I say, a residential offset as well, if that's something you wanted to consider as well. I think we already touched on the buy-to-let there. We are at 65%. We will allow first-time landlords. As I say, no minimum income. We do not stress the portfolio, and we also assist with limited company buy-to-lets as well. And even if they are not prepared to give personal guarantees, we're happy up to 55%. Is that the 20 minutes, Tony?
No, not at all. I'm just coming back. I'm just making sure that my software is working.
Okay.
I'm not going to speak because we've got terrible feedback between yours and mine. So I'll start the questions in a minute.
Okay.
So go on. You carry on.
So that is a very, very brief canter through what we offer. Obviously, any questions, if you want to throw them across to me, more than happy to do it. I mean, am I to answer the questions that are written there then, Tony?
Yeah, absolutely.
Yeah. Expat transfer of equity remorse to the elderly mum can remain in the house with the mortgage. So we got okay. Yeah, for an expat, so if usually for an expat for a residential, we want the relationship to be a spouse. They on exceptions, we can allow someone who's the daughter to live and working overseas and mum to be living here. Now, presumably, we're looking at this as a residential. It would, client's divorce. It would be one where I would have to take that to an underwriter to see if we can get an exception, because say our policy normally is husband, wife, or whatever the setup is. One of them lives and works overseas, and the spouse remains and are on the mortgage. Now, I have had one or two of these agreed, so it might be one that I could take to my director of lending and discuss it with him to see if we could do it. So you could, yeah, so somebody like in that, with that sort of income and profile would be one we could look at. I mean, if you want to send me the details or give me a call, by all means, Tony, isn't it? If we read that properly, yeah.
I can give you details later, Darren.
Yes, sure. Yeah, I'll take that on myself. If Tony wants to send that across, I will refer that.
All right, brilliant. Forgive the feedback, everybody. That we're having the system. So, Darren, could you just turn your mic off a second? And that way we haven't got the feedback there, so you won't hear me say something 3 times. So, Darren, what is the maximum age an applicant can apply for to apply for a mortgage with you?
Well, for an interest-only mortgage, an applicant can be 89 at application stage. Would still be able to offer a 5-year term. your applicant could be 90 even for a repayment mortgage. It would only be a 5-year term, highly unlikely. So something that's more feasible, an 89-year-old on interest only, we could still do for a 5-year term.
Okay. Do you want to mute it again? You have? Oh, excellent. Okay. Do you stress a background portfolio for professional landlords?
No, as I say, we get asked it a lot. That's why I did stress that in the presentation. We're not worried about how many properties they've got. We're not looking at stressing the background. We're not looking at income in that we have a minimum. We're not worried if it's their only income is property income. So no, we just want to know that they are all paid, they are clean and clear, and then we will concentrate on the property that you're asking us to look at. Okay.
Right. So there was one thing actually in that I realised that we sent all the information out to everybody on Monday. It looks like they possibly increased their number of acceptable countries for expats. I seem to remember there was 41 on our list, so it now looks like it's gone up to 45. So probably best just to make a phone call. If it's on one of the countries, it's on the ban list, then don't waste your money or your time. We're not I don't think anyone's doing anybody that's currently an expat living in Yemen or Syria, for example. But if it's one that you think is that one that potentially could be, just give us a call and we'll find out straight away. As these things keep moving so quickly, probably sometimes the last thing that gets updated is a lender's website. So, but certainly the BDMs and the underwriters at Family Building Society will be aware of what they're able to accept. So, Darren, that's absolutely brilliant. Thank you very much. I hope we all found that very, very interesting. I know I have when I've listened to Darren's in the past a few months ago. Found it very enlightening. So, and say we're absolutely delighted to be on board with Family Building Society and to throw in loads of business their way. So, Darren, thank you very much. If you want to give us a wave, and there you go. And what we'll do now, we'll go to our final speaker, who's about to be added as a presenter. And I'll just put up her introduction. So this is our full speaker, Sammi Gilbank from Hampshire Trust Bank, somebody I've known for a long, long time. She was previously our underwriter at Interbay, was our underwriter also at Hampshire Trust Bank. Absolutely lovely lady, and really does know her stuff, as you'll probably realise when you see some of her background that I'm about to tell you. You would receive this in the post and also on email this morning, which is their current terms. So just please refer to that. And my slides seem to be a little bit quicker this time around. Sammi started her career in financial services back in 1995 as a secured loan clerk for First National Bank. Oh, I remember them. She has progressed through various roles over the years, from administration to underwriting, and has worked for other banks as well as direct brokerages on an advisory basis, and spent 10 years working as a packager. Seen many changes over the years, and a variety of roles she's held have given an all-round understanding from a broker, borrower and lender perspective. Absolutely vital that, by the way. You've got somebody who's worked for both a lender and a broker. They really do know the way things work. We've all encountered underwriters at the time and staff at lenders who've never been on the broker side and just really have no clue what life is about sometimes. It's not all work. She has a passion for music, playing, listening, not playing. Sammi goes to many live concerts and loves the theatre too, something she's really missing these strange times. And she also lives close to the New Forest and has recently started cycling, which has certainly made her appreciate what's right on her doorstep. Hopefully that's not donkey manure, but having been to the New Forest. But anyway, that's another matter. On to her interesting fact. I was bored last night, by the way, when I was doing this, because my wife was watching some nonsense on the telly. So I actually added the Blue Peter badge. So Sammi holds a Blue Peter badge, excuse me, after appearing on the show in the 1980s, obviously the late 1980s, as part of a dance school production being performed live at her local theatre. So there you go. So I will now put Sammi's slides up, and hopefully she's going to be coming on as a presenter anytime now. We hope. Yeah, here she comes. She's about to appear.
Hello.
Hello, Sammi. How are you?
Yes, very well, thank you. Very warm,
Excellent.
but very well.
We will crack on because we're dead on time. So you,
okay.
As you're aware, your chair is electrified. If you go 1 minute over time, then we're pressing a button, you'll get 50,000 volts. So just be aware. We're right on time. Over to you, and I'll see you in 20 minutes.
Okay, fantastic. Good afternoon, guys. I am Sammi from HDB, as Tony has said. I work within the Specialist Mortgages Division of Hampshire Trust Bank, where we are lending non-regulated mortgages. So everything that we do is either buy-to-let, semi-commercial, and we also do a little bit of short-term lending as well. So what I'm going to do is just kind of talk you through where we currently are in the marketplace, what appetite we have, the types of borrowers that we'll lend to, and the types of properties that we'll lend on, just to give you a real flavour of where we sit, and hopefully where you will be able to place some of your cases that perhaps you may be finding difficult to place with lenders at the moment, obviously through Specialist. What makes us slightly different from our peers and other lenders in the same space as us is that we are very much a personal kind of human approach touch lender. Everything that we do currently is on a manual basis, and that's right from the very start when we're looking at the inquiries, the decision in principles, and then also while we're taking that application through the process, it's always human touch, human pair of eyes, and conversations that we're having. And the reason for that is because what we do is quite complex. So rather than having just a black and white kind of guide that we stick to, what we tend to do is a little bit more grey. And as I'm sure you can all appreciate, what that actually means is it does need to have discussions from time to time. So we try and think outside the box wherever possible. And as I'm talking you through the types of products that we offer, that will probably really come through. So currently, we can lend up to 15 million, that is per borrower. So that would either be in their personal name or in a limited company or a combination of the two. We also have development finance division within the bank, so that £15 million exposure is across the bank, across any accounts that they hold. We can lend up to 75% loan to value, with arrangement fees being added on top of that, provided we've got the rental cover to cover the gross loan. We currently have no maximum age at all, so that's either at application stage or end of term. All we're looking for is, if the applicant is in their more advanced years, that we have some kind of succession plan in place. We just need to be made aware of what that is. We don't actually need to see the evidence of it. We don't have a minimum income requirement. So if you do have portfolio landlords where all their income is derived from their portfolio, that's absolutely fine. And we're only offering fixed rates. That's 2 and 5 years. The reason for that, it just gives us a really simple product range. As I'm going through this and you look at the different types of borrowers and different types of properties that we're lending to and on, our fixed rates are what they say they are. So no matter what the circumstances, you'll find that there are no loadings added at all. So who do we lend to? Well, we lend to a whole host of different borrower types, from individual landlords to portfolio landlords. We also lend to trusts and offshore companies. The offshore companies, we are pretty much there or thereabouts considering most countries out there. There are a few that we can't consider, but because that list is forever changing, it's definitely a call to Specialist to see whether or not that's something that we can consider. Surprisingly, we are lending to offshore companies that are in more high risk areas. If it is a high risk country, it doesn't automatically mean that we can't do it. We just need to be looking at the borrower and applying the correct due diligence to make sure that we're all compliant. Portfolio landlords, any size. So we've got no restriction on the number of properties that are held within that portfolio. We do stress the back portfolio, and that is done at 5% based on 125% coverage, and that is something that we are quite strict on. New SPV, so we've got no minimum time trading, so day one new SPV set up to hold property absolutely fine with us. And then we've also got the other side to that. So your trading limited company, again, no minimum time trading, but it really can be any trading company. So we don't need to have it set up with a specific SIC code in the background. With regards to our expats and foreign nationals, on those, again, very, very similar to our offshore companies, we do have a list of countries and they're graded from low through to high risk. There's a very few that we actually say no to, but again, a call to specialists to just determine whether or not it is actually too high risk for us to consider. With regards to expats and foreign nationals, we can lend to foreign nationals either residing in the UK. They do not need to have permanent rights to reside, or they can be residing in their own country or another country. So what we're looking for is a UK footprint that can either ideally be a property based in the UK, but if not, we do accept if they've got bank account here or a limited company here, something that we can search on and get a credit score from, as long as that meets our minimum requirement of 750. Then we can consider on that basis. With regards to expats as well, we're primarily looking for expats that already hold investment properties in the UK. We could consider on a first-time landlord basis for expats, but we would need them to be a residential homeowner in the country in which they are living. That's the same for foreign nationals too. So if we've got a first-time landlord scenario, they do have to be residential homeowners. So that ties in nicely with the first-time landlords, exactly the same as per expats and foreign nationals. First-time landlords we can consider lending to, but they would need to have a residential mortgage in the background. So we can't do a first-time buyer, first-time landlord scenario. So to complement the types of borrowers that we're lending to, the types of properties that we're lending on, again, there's quite a wide variety of property types we can consider as suitable investments for us. We've got new build flats in there, so where we've got our 75% LTV limit, all these property types shown here, we do not restrict on the LTV. There's a couple that I'm going through. As I'm going through, I'll explain to you, we probably have a little bit more limited appetite for just in the current market, but new build flats we are actually fine with up to 75% LTV. HMOs, we've got no restriction on the size of the HMOs, so that can be any number of rooms at all. Combinations between borrowers, first-time landlord, that's where you're going to see that we won't allow for an HMO, because if it's their first investment, then obviously we do need them to be an experienced landlord. With regards to freehold blocks, we can do any number of units within a freehold block, so the large multi-units, that's absolutely fine for us to consider. Quite often, just depending on the type of block that it is and whether or not it's been held as investment for a long time, there is the possibility that we could actually apply a block value to that. Serviced accommodation is something that we have less of an appetite for in the current market, because I'm sure you can appreciate if you've got an apartment in the middle of London or another large city centre at the moment, the chances are it's probably sitting empty. We do still look at holiday lets. Again, that's something that we've just come back into doing because we've recognised there is a high demand for holiday lets, with everybody looking to take their holidays in the UK rather than jetting off abroad. So if you've got serviced accommodation, but it lends itself to being somewhere that potentially a family could look to stay in for a whole week, so it's more around a coastal area, that's something that we could look at. But if you've got serviced accommodation, an apartment in a large city centre, then that's where we've got less appetite at the moment. Regarding the holiday lets, what we're looking for on those is no restrictions on the title. So we're looking for a property that could obviously lends itself well to being a holiday let because of where it's located. But should it ever come back to market, we'd like to think that it would have dual marketability. So if it's got residential planning in place, we know it would appeal to, family occupation or indeed as a holiday let. DSS tenants we can consider without any issue at all. So that's where they're on income support or income benefit. we wouldn't lend where any tenant would be deemed to be vulnerable in any way. So if we've got potentially ex-offenders or recovering addicts, something like that, then that would definitely be a no from us. But DSS tenants as a whole, generally acceptable. And if you've got a really strong borrower with a large amount of income in the background, but they're holding some properties which are a little bit more low yielding, we can consider an income top up from their outside income. Very simple approach to that. What we're looking to do is go through their income and expenditure, and the surplus they have left with all of their expenses taken off is what we can potentially apply back to get us where we need to be in terms of borrowing to top up that low rent. We do cap it at 30%. Can consider more for high net worth clients, but that's where I said we are a little bit grey. So we've got some layers in place where we do have appetite, but if you've got a very strong client or a very strong property, again, always open to having a conversation with specialists to see if it's something that we can consider. Quick recap there. So 75%, as I say, we can add our arrangement fee beyond that, provided the gross rental income covers the whole debt. Our arrangement fee, as you can see there, is 2%. That's across all of our cases, and that obviously can be added above that 75%. And then they're the fixed rates for 2 or 5 years. We did recently introduce a new product. It's a 5-2 product, a little bit different from what's in the rest of the marketplace at the moment. What we've got is a 5-year fixed rate product, but it only has a 2-year tie-in. So it's really useful for this current climate. If, for example, you may have a developer that's got a portfolio of properties in the background, has done a recent development, but rather than sell them, he wants to retain them and then maybe think to sell them on in a couple of years when that market's settled. He can have the advantage of using the rental cover on our 5-year fixed rate, which is always done at pay rate, but then only tied in for it for 2 years, and then obviously no ERCs following that. So the other parts to what we do, as I mentioned at the beginning, we've got the buy-to-lets, and then off the back of that, we've also got the semi-commercial offering as well. With semi-commercial, it really is semi-commercial, so it's got to have a residential element to it. We can't lend currently where it's a wholly commercial asset. But again, you'll see from here, we are lending on a manually underwritten basis, 2% arrangement fee, all fixed rates again. And we do allow interest only on our semi-commercial as well. So our term is maximum 30 years, and potentially you could have either capital repayment or an interest only mortgage up to a 30-year term. Rate starting from 4.8%, so for semi-commercial, that's pretty good. You'll see one of the boxes there says up to 40% commercial. Just going to take you on to the next slide, which does explain that in a little bit more detail. So what helps us to keep our pricing a little bit lower on our semi-commercial offering is because we are looking at securities where the weighting of the property is more on the residential than it is on the commercial. So of the overall asset value, we need 60% to sit within the residential part. So for example, as you can see there, if the overall value of the security is 300,000, we need 180k to be attributed to that residential part, and we are strict on that. So it's fine if you've got a shop at the bottom with a couple of or 2, 3 flats above, where it comes difficult to kind of decipher, is this going to work on this 60-40 split, is obviously where you've got one residential unit above one commercial. We can consider lending on a whole different type of commercial occupying the ground part. So anything, as you can see from the list there, from offices, shops, restaurants, takeaways, fast food outlets, beauty salons, hairdressers, etc., etc. So probably the key one there, which other lenders may not be so keen on, is the restaurants, takeaways, fast food outlets. It is also worth noting that if we're lending on a flat located above commercial and it's sold off on its own, individual long leasehold title, we can lend above any of those commercial types. So again, we don't restrict if the security is located above or adjacent to restaurants, takeaways, fast food outlets. And again, we're right up to 75% LTV on that. If we've got a really good location, we can consider where they're above pubs and other such places. Central London, most security is going to be above these types of commercial, or indeed could be located above pubs and restaurants combined. So we again don't have any restrictions there as well. It's probably also worth noting, well, not probably, it is worth noting that all those different borrower types that I spoke about at the very beginning, we also lend to all of those different borrower types when it comes to our semi-commercial prospect as well. So there are no restrictions on the borrower types combined with the property types. Last part of what we do, residential and commercial bridging. So it says commercial, but again, we're really talking about those semi-commercial assets which have got that element of residential in with them. Short-term loans, again, we can lend up to 75% gross. So rather than being the net as it was before, 75% gross on the short-term loans. So that does have to include fees and interest roll-up. Just bear with me a second. I'm having a little bit of trouble getting it onto the next slide. Bear with me. No, sorry, it won't go. It's fine. I can talk us through it from memory. Obviously, going back to the other slides there, we know the borrower types that we can lend on or lend to, but with our short-term loans, what it is, there we go, fantastic, thank you. So our bridging features there, 75% gross, so including fees and interest roll-up. We offer dual representation from a legal perspective because what that does is actually speeds up the whole process. You have a dedicated case manager and underwriter. We aim for 21 days from application to completion, and we have managed to stick to that through COVID, finding some thankfully good surveyors that were on board to try and kind of get these cases through quickly. We have no ERCs on our short-term bridging loans, just a minimum 3 months interest. And we can allow up to a 24-month term, 12 months on the semi-commercial. We will lend for light refurb, auction purchase, any reasonable kind of cash raise that is acceptable will be absolutely fine for us. What we don't do on our short-term and bridging loans is heavy refurb or ground up development stuff. So everything that we do is kind of light touch refurb. Perfect example would be a property that's purchased at auction. It's a single family dwelling, and what they're looking to do is actually turn that into an HMO. So just a little bit of internal reconfiguration. So we, on that scenario, could lend the bridge for them to purchase the property at auction, provided they've got the monies to do the works themselves to turn it into the HMO, great. And then once those works have been completed, we can actually look to take that back and hold it on one of our term loans. We don't insist that they have the exit with us. Now, obviously, it does kind of keep it nice and neat for you guys and for specialists if we're kind of all in-house doing both ends, as it were. Rate-wise, we are very competitive. So our rates start at 0.55% per month up to 0.65% per month. And as I say, that is on a gross loan basis. So that kind of covers off all our different product ranges. We've got the buy-to-let, the semi-commercial, and then our short-term bridging loan offering. I'm pretty sure the next slide, if someone could kindly push it on for me, is just a quick recap of what I have said there in terms of our bridging. Yep, there we go. So exactly where you would see what our bridging being used for. And on the next slide following that, that would just be a recap of what I've said in terms of the no ARCs and the title insurance available, etc., etc. And then the next slide, I believe, is to open up kind of how you can help specialists getting the cases through quickly. And the quickest way to do that is just ensuring that the documentation provided is accurate and working to the list of required documents, getting the information back in one go. So it's so difficult for specialists and for our underwriters to review a case quickly and thoroughly if they're getting the information piecemeal. Best thing to do is to have all the information to hand in one go so we can really look at the case and in its entirety. And what that will do is just speed up the whole process going through from start to finish. Missing out a name, a misspelling of something can cause no end of problems, as obviously the life of the loan, as it progresses, something that could be picked up right at the start then causes no end of issues later down the line. Worth noting, we do all our credit searches and all our land reg searches up front, so at DIP stage, which means that you've got peace of mind that, you know, we've covered everything that we need to right at the start. And when you've got your shopping list, as long as you can provide the documents that we need, then that case should go through. And then I think the next slide, if we go on to the next one, that probably just covers again what I've been saying about the speed of the cases going through. The biggest thing that holds up anything that's semi-commercial or commercial is the occupational leases being completed incorrectly. So obviously we engage with our solicitors, specialists engage with our solicitors, and 9 times out of 10, what holds up the completion will be the documentation that's come over from the borrower's chosen solicitor, which could be poorly completed. And again, that's what causes the issues and the hold-ups. Reports which should be readily available, not being available. So all these things, it's worth covering off with your clients and with specialists right at the start of the process, so we all know what's needed and that we can get it through. So if your client has got a time they need to complete this in, we can work towards doing that for them. So there we are, up to 15 million, up to 75%, no maximum age and no minimum income, and just fixed rates 2 or 5 years with no loading depending on the borrower type or the property.
Sammi, I'm back. Okay.
Hello.
Thank you.
Great.
Excellent.
That's all right.
You've had a number of questions, as you probably can see.
Yes.
Including one which wasn't a question, just somebody saying, "Oh no, Sammi lives near us." I know who he is, by the way, so we'll probably go in and see him. So, okay, so Tony's, who's an existing HTB broker, said, "I have an experienced landlord that is a church and registered charity, and they want to buy some, I presume that's multi-unit freehold blocks, Tony." Mm-hmm. He said he can't go all his BDM. If you want to answer that, it's...
Essentially, we have considered lending to charities in the past, but I believe we would have an issue if it's a church, because I've had a very similar inquiry recently. I will double check on that for you. And if we could have the name of the registered charity, we can just do a quick search and see kind of if there are any restrictions imposed by them with regards to borrowing limits, etc., etc. But we have lent to charities in the past.
Okay. Harry's asked, Sammi, you mentioned a minimum credit score of 750. Which credit reference agency is this linked to?
That's linked to Experian.
Okay, there you go. Magda has asked, is a new SPV acceptable where the director is a foreign national living in Poland with residential property there?
Yes, it is. All I would say is because they have to have that footprint in the UK to give that minimum credit score, it's just going to depend on how long that SPV has been up and running for us to actually get a search and a score on it. But in principle, Yes, we can.
Okay, obviously you also have to have a UK bank account, which is also another important matter.
Yes.
And we did have another question that was coming up, but oh no, there are more questions. They're below my screen. There you go, Michael. Hello, Michael. Thanks for attending today. Some lenders insist upon their preferred solicitors being used, which frequently causes problems. What is your stance?
So we have a panel of solicitors that we will want to act for HTB. Those include Parasmith, Lightfoots, Glovers and TLTs. We then allow the borrower to have their own solicitor representing them. We've got no restrictions. They just need to be registered with the Law Society.
Okay, we've got very good relationships with all the HTB solicitors. Just to let you know, just also, one thing I didn't say right at the start. We've been HTB's largest broker throughout the last 4 years since they launched in May 2016, I believe. Yes. So we do know them back to front, inside out. And I do have staff who previously worked at Hampshire Trust, and they obviously also know their system inside out and have got the contacts there as well to get things moving quickly. So, and I've got very, very good contacts and very good friends with the top solicitor at Parasmith, for example, who once a year takes me out and fills me full of very, very expensive scotch. So
you get more out of him than I do.
Yes, which I've not said no so far. So there you go. Next question I've got is from Preet. Is it a definite no if the residential element of a semi-commercial is below 50%?
Yes. There is no leeway on
that at all.
No. Unfortunately, it's a definite no. Whilst there are other areas of our criteria that we can look at and take a view on, that is the one part where we just have no leeway. And the reason for that is that the pricing is linked to the risk rating that's applied. So the pricing that we have needs to have that 60-40 split. And because we're not lending on wholly commercial at the moment, we couldn't then just adapt a commercial pricing to push it through. So it really has to be 60-40.
Fine. Okay. Some pre-prepared questions. Tony Silva has said no restrictions. Tony, probably best on that one. If I email you Sammi's email address or telephone number, maybe just speak to her directly on that, and she can cover that off for you. So, Sammi, what is the maximum age Hampshire Trust will lend to?
There isn't one at all. So, no maximum age at the start of the process, no maximum age at the end of the process, and we don't restrict the term either. It just needs to make sense. And as I said, if you've got someone who is in their 80s, for example, we're going to want to see a succession plan in place. We don't want evidence of that. We just need to know kind of what it is, and as long as it all makes sense, then we're not going to have an issue.
Okay. I'll give you an example. We actually slightly ahead of time. So to give you a quick example, we've just we've put a case in where it's an expat living in Israel who's 80 years old and has a portfolio that he has to get away from his existing lender because it's come to end of term. They're no longer lending, and that's something that HTB are actively considering. And his succession planning is that he's got 16 children. One of those will become director and will be getting his shares. So that's one they are actively considering at the moment. Quite a complicated one, as you can imagine. That's also a mixture of residential and semi-commercial, and also has several properties in it that have, what's the type of tenancy, Sammi? My mind's gone blank.
Regulated
tenancies. I think 6 of the properties have regulated tenancies as well. So you can imagine, not an easy case, but it's one they are actively considering. That's when it helps when you have the contacts we have within Hampshire, because we've been their largest throughout the last 4 years. So one last question then, Sammi. I've got, can HTB consider lending to foreign nationals residing in their own country?
Yes, we can. So the key is for them to have a footprint in the UK. Bank account, limited company. They've just got to have something here that we can actually do a search on. So the fact that they're residing outside of the UK and they're a foreign national is not an issue. We just check the country that they are from or residing in to make sure that it's not deemed as being too high risk. And obviously that's done by yourselves to us.
That's brilliant. Okay, well, Sammi, thank you very much. Thank you also for being absolutely bang on time with your presentation and also the questions. We're about to 12:30. So thank you, as always. And say, if you've got anything that you'd like to run past Hampshire Trust, just give us a call, because we do a lot of business with Hampshire Trust, hell of a lot of business. So, okay. So, Sammi, you're going to wake up for me.
Thank you
and
for your time.
I'll finish on my bit.